In this module, we cover the co-op difference, why RUS makes the rules, and the difference between co-ops and utilities, plus the regulatory landscape. So kind of a smorgasbord of different topics. So what makes a co-op different? Well, co-ops are owned by their members. You saw from the structure in the last module that investor-owned utilities are owned by stockholders and municipal utilities are units of government, but co-ops are owned by their members. And so the people who receive electric service are the owners, and the fundamental difference drives everything about co-op accounting, governance, and operations. So your members are heavily involved in the governance of your organization. And we call that patronage capital. So what happens is this: your members invest in the co-op and originally invested in the co-op along with other funding to get service to their residences and their businesses and their farms and so on. So the members invest in the co-op so that it can construct facilities to serve them. And then what happens is the year goes by, and at the end of the year you determine what your net income is, and we call that margin. And the net margins are then allocated to members based on their usage, and we call that patronage. And in strong financial years, you will see that sometimes capital credits, that is the investment that your members have in the co-op, are retired or returned to their members. So you'll write a check to members that have invested in the co-op over the years. Usually you do this on a first in, first out basis. So if it's year 20, perhaps you're having capital retirements of year 1 contributions, things like that. And that's in strong financial years. In less than strong financial years, you may not have capital credit retirements and those return to members. So again, that investment by the members in the co-op drives performance, drives infrastructure. So that is equity, not debt. Members do have an ownership stake in your assets. Then when it comes to governance in a co-op, you have a board of directors that are elected by members. So your board of directors are members too. So you generally have an election, and your board of directors has the power to set your rates, approve your budgets, make strategic decisions, just like any oversight body. So your member input is they'll vote for board members, attend the annual meetings, they'll have input on or voice concerns about rates, participate in governance, but the board's authority leads to rate approval and financial policies, overseeing management, and returning capital credits and setting a policy for that as well. But your board members are members and also have a stake in the outcome as well. Then we have the Rural Utility Service, RUS. So RUS is part of the U.S. Department of Agriculture, and it was created to bring electricity to rural America. Back in the day, there was the rural America was very underserved, and so RUS was formed to fund initial electric service in rural areas, along with member equity and contributions, and that brought electricity or made electricity more available throughout the rural areas of the United States. And the RUS regulates financial and operating reports, requires you to have a work order system, also sets depreciation rates, has the uniform system of accounts, and you have to follow RUS regulations if you have RUS debt. And RUS does provide financing for co-ops. You know, they have very low-cost loans, funding for infrastructure. They provide technical assistance and industry guidance. But if you don't have RUS debt, you technically are not required to follow RUS reporting requirements or even follow the RUS Uniform System of Accounts. But I haven't run across a co-op yet that does not follow the RUS USOA because it's the industry standard. It's the best practice in the business, and it really is a benefit to follow that. So the regulatory landscape, we just talked about the RUS. I mentioned earlier the FERC, Federal Energy Regulatory Commission. FERC regulates interstate, intrastate electricity sales, wholesale electric rates, hydro licensing for dams, and some co-ops file with FERC, and I don't want to get into it, it's a fairly complicated, but if you're in a co-op that has a member that falls under FERC jurisdiction, technically you also fall under FERC jurisdiction as well. Kind of an interesting quirk, but let's focus on RUS for now. Then there's another organization called NERC, the North American Energy Reliability Corporation. NERC governs the electric grid nationwide. They have compliance standards, and then they go out and audit transmission owners and providers, and they determine if these providers are following their rules on critical infrastructure protection standards, and if they aren't, that they levy fines for non-compliance to help bring them into compliance as well. And then for investor-owned utilities, you have state public utility commissions, and some states regulate co-ops, not really too much, we're not going to get any deeper into that, but technically state utility commissions govern the rates of investor-owned utilities and have authority over those organizations. So let's switch back to the RUS and the Uniform System of Accounts. It really is a great tool and a great benefit that is used by cooperatives. What it provides is comparability. You can compare your co-op to peers across the country because you have consistency. You're using the same accounts, you're following the same rules, and you have reliable reporting. And this all feeds into rate making. So the RUS USOA is the foundation for accurate cost of service studies. As I said earlier, where you code things drives member rates. And it's done through a cost of service study where allocations are made based on the account where transactions are coded to. Then there's compliance. You meet RUS loan requirements and reporting standards if you have RUS debt, and you do that by following the RUS USOA and the requirements therein that we'll talk about and get a look at in an upcoming module. On the audit front, standardized framework really streamlines your audits, and then benchmarks go with that comparability factor. You can make meaningful performance comparisons to your peer electric co-ops. So regulatory accounting is really what we're talking about here. Technically, this is called regulatory accounting. So you don't get to make up your own chart of accounts. Just think if we could do that, it'd be not chaos, but there wouldn't be comparability. So using that RUS Uniform System of Accounts, the RUSOA really gives you that comparability, consistency, and that all, again, feeds your members' rate. I totally see this as a benefit. And for utilities that follow the FERC Uniform System of Accounts, they receive the same benefits as well. Comparability, consistency, and for both of those, it's the result of decades of industry best practices. They do change from time to time, and really it gives you a good roadmap for every accounting situation. So the takeaways for this module are this. Co-ops are owned by your members. Patronage capital is the reinvestment by your members in the co-op. You're governed by a board of directors who are also members of the co-op. And if you have RUS debt, that's a primary regulator and lender for electric co-ops. If you don't have RUS debt, you don't have to follow the RUS USOA, but like I said, I haven't seen a co-op that doesn't. And that RUS USOA gives you consistency and comparability. So now that we've set the table, let's take a detailed look at the RUS USOA.